Greetings, traders. Thank you for joining me on this guest captain interview series. I am waiting right now to give Bob some power here so he could share his, there he is, promote to panelist. All right, Robert, can you hear me? We got audio, it's recording. Just need to show your mug. Come on. Hopefully you can, there you are, coming in.
Cool.
Yay, I'm excited. All right.
Sorry about that.
No worries. We should have gone a few more seconds in. I just wanted to let everyone know that I'm very excited because the guest captain interview series is for me to bring analysts and traders in who have deep subject matter expertise. And Bob is my favorite oil trader. He is someone who has a very deep background, but also looks at kind of a modality of different components that make up his oil thesis, bullish, bearish. He's actually an excellent trader, although he says he doesn't make forecasts. I would argue with that. He's actually really good at forecasting what risk is coming around the corner, whether it be geopolitical. Definitely, he's going to talk about the recent backdrop. And we've kind of gotten along, if you will, on different ways of approaching equities and oil markets. Even though we come from very different backgrounds, it's kind of cool when it times. So one of the things I wanted to get into with Robert was how he approaches his process, specific models that he uses. But first, an introduction. Those who are maybe new to LaDuc Trading. My name is Samantha LaDuc, and I founded LaDucTrading.com, also LaDuc Capital LLC. I'm an analyst, educator, and trader. More to the point, I trade for a living, and I support clients who do the same. I have a website, LaDucTrading.com. I'm very active, if you will, which is where I found Robert on Twitter. And I approach the market from a framework of using macro and fundamentals as a backdrop, but very much focused on the intermarket relationships and technical analysis. Throw in a little bit of quant and sentiment to the equation, and I do equities across asset classes and basically retail and institutional clients. Robert is a just solid oil analyst and trader that I have come to know over the years. And we have, like I said, very different backgrounds, but they kind of converge, and we like to talk shop. And today we decided to make it live, so you get to kind of eavesdrop on some of our conversations that we've had via direct message and phone call. And without further ado, Robert, give a little bit of a background on yourself and the clients that you serve as well, because you are private. You get a small under the radar presence on Twitter, and yet that's my job, is to find traders who are in the zone. That's really what I like to do, is find experts, and you're one. So how'd you get here, and what's your story?
Well, thanks. Appreciate you having me on. I think you called me the old oil trader, right?
Only once.
So I'm the oily guy. I've been in the business for about 35 years. So worked for a couple of major integrated players here in Canada, some large independents, started a trade association, had my own consultancy since '94, advising downstream marketers on fuel and hedging, active trader in the market against physical, and in my own book. Had a fuel company that I just recently sold in 2017, and I've moved back to Halifax here on the harbor. It's great. You're going to have you up in once we get out of the bubble here, right? Maybe
Yeah, really.
A motorbike ride.
Yeah. Absolutely.
So so I sort of watched the oil market trade, as I say, tick for tick for 30 years. So I guess that does make me an old guy, and I think that's part of being through so much and seeing how the market's evolved. That's given me a perspective, and it's certainly grown over the years. So this is the part where we warn people about our discussions or whatever.
Yes,
basically,
trade at your own risk. Yes, we make our own luck. The usual customary. Yes.
Yeah, bomb making at home, right? Yeah. So I think it's important that you hear from different people in terms of different perspectives. So I'd second your comments about that. And yes, I found it really intriguing that you and I, once we started chatting on Twitter, were coming to the same conclusions through completely different process. So I think that's from a lot of your flow work or whatever. And so I was always intrigued by what a good trader you were, and how you're coming to your conclusions. And it's ironic that when we do chat and I share an idea with you, you're kind of like already onto it or thinking the same thing. So I was
You're one of my
also,
confirmation biases, by the way, because
yeah, exactly. You're not, yeah. I was just a joke about Jeff Curry at Goldman Sachs. I'd always fade him or whatever. So um, yeah, I think it's kind of cool. And
no, it's the
also,
opposite. It's the opposite. When you come into it, when we start talking again, you're onto something. Like you smell something, and I'm in the
yeah.
back going, okay, I'm waiting for an inflection point. Oh, there's Bob. It's got to be coming.
Right. So I was always intrigued by your macro to micro handle. So maybe I could just ask you, like, what came first, macro or micro, or how
Oh,
did that
definitely the
process evolve
micro.
with you?
Yeah, definitely the
So
micro.
bottoms up to start. Yeah.
Yeah, I think getting into this market was for me kind of, I don't want to call it an accident, but September 2008. So Lehman Brothers collapse. And my son had actually had a medical emergency a year and a half prior. So I had sold my business from ICU, Boston Children's Hospital, and hadn't worked, if you will. But when he went back to school, I just decided it wasn't a real good background in the economy to kind of start a business. So I decided I would do this, but believe it or not, full time, manage my money and try and grow it. And I really started from the fundamental and then went right into the technical. And over the years, I just wanted to understand not price points, stop loss, profit target, but why something was moving, how to trade it, the inflection points, timing market turns. I actually ended up becoming known as more of a volatility trader. And I joked it was because I have teenagers. I had all three are in college now, but I that was, my handle.
Right.
But the point is, this definitely started out in pattern recognition and, technical analysis. But then I really wanted to know the divergences and the relationships, dollar, right? The currencies, which we're going to talk about, you're not so keen on, but the macro backdrop, because policies dictate economics and the economy. So I wanted to understand more of the macro backdrop, and I was just a student in that particular point. I mean, you grew up in your dad was in the oil markets. You have been in the oil markets solid. So I am a generalist. I'm a solid generalist. Your specialty is oil, but I like how, like I said, I'm looking for inflection points, and I'm patient, right? I had to stay away from the cookie jar, of oil, and then all of a sudden you pop in. I'm like, gosh darn it, it's going to move now because Bob's here, and then it does. You have incredible, impeccable timing of the turns in the oil trade or the integrateds. So that's why we're talking, because there was a ginormous reflation trade on Monday, but you had already been in it for 2 weeks. We talked about this. So
yeah, I think it's just I have my own views on macro too. It's the oil market's pretty complicated. It's obviously heavily financialized, very large market. So so my specialty is oil. That's all I trade. But and I try not to get too wrapped up in each of the individual components. I find in oil trading, there's lots of subject matter expertise within oil. Like I'm a crude trader and I know time spreads and I know cargoes, or I'm downstream analyst. And I think you need a broader look at oil, and you can't get too involved in any one particular area, just in terms of it creates a bias, a blind spot, and it's a huge time sucker too. So I tried to create a model that allows me to watch a bunch of different elements in the oil market, but not get too deeply involved in them, so I can be sort of opportunistic and trade. I think you called me an opportunist before, and I think that was a good characterization. No one had ever told me that, but that's how I try to trade, as an opportunist or whatever. So
And you're also, I mean, not for nothing, but your tweets are a little bit cryptic because you really have strong conviction, and you are subtle, let's just call it, in your tweets for those who are unsuspecting. I can read a little bit more into that because we've talked, back and forth. But your timing is, I think, I can see your conviction growing before you go in like a shark, right? Like, so I can see it building. I can see it building. You are very patient. You're an opportunistic trader, but you are patient. You're waiting, absolutely. And then you go in kind of large in size, don't you?
Yeah, I wanted to talk about that evolution, which is kind of neat. And just pre-announce if there's any of my Twitter followers, I do tend to be kind of cryptic and maybe even borderline rude at times, but I'm really just having fun, and I really appreciate it. Met some great people online, and who's someone who had either a Reuters or a Bloomberg terminal forever, where you needed that community. I mean, Twitter just replaces everything. There's a lot of great information there, but for me, it's a sentiment and a narrative builder because everyone wants to share their view, everyone wants to share their forecast. So that's why I love Twitter. It's going to, hard to get rid of that. People talk about moving to other platforms, and I miss that. I don't have a Bloomberg or Reuters terminal now. I have Twitter, and that's completely fine in terms of what I do. But I started out trading. I was an incredibly aggressive trader, like a lot every day, like just a lot. I remember, generated tens of thousands of dollars from my broker. I remember compliance would call me once every couple of months. Go, are you okay, Bob? Like, you sure everything's all right? And I was like, yeah, but I think that over trading, if you want to call it, was a great learning ground too. That was the day when, the open pit was still at the Merc, and you'd call down and place your orders, and I could hear what's going on the floor. And I would talk with my broker, who still is a good friend today and still a broker, and, understands the Northeast fuel market incredibly well. So it was a good training ground. And, I think like most people, you focus on different disciplines. I mean, I was heavy into charts and technical analysis at the start, read every candlestick book you can think of. Elliott Wave guy for a while, even subscribed to their service, kind of got tired with alternate counts after a while. And then spent a lot of time doing event trading, actually. I remember I used to trading the APIs when APIs were the number, when the DOEs were the nothing report, and trying to game that market on the release on Tuesday nights. And then that sort of got, that wasn't quite as efficient anymore. And of course the DOEs became the report of focus, and it's pretty hard to jump into the fray there at 10:30 or 9:30 in the morning in the NYMEX. So, and over time, I think I've just settled into what you said, sort of just a patient, disciplined trader. That same broker gave me the famous saying, and I'm sure you've heard it many times, like, there's a trade every day, Bob, but you don't need to trade every day. So I think working with a lot of end users, like in my own fuel companies, we're sort of net short. I mean, we had physical inventory, and but if you're net short, you have to buy in the future. I always look at things from a risk management point of view in terms of, can there be, in case of someone who's not short, can there be a period of sustained higher prices? So I think it made me more analytical in terms of, what's more likely to happen. And so, I really, I tell people there might be 3 or 4 good trades a year. So it's really easy to get into, swing trading,
when you are convicted.
Especially when you're winning and you're back and forth and back and forth. So I try not to do that. And so I become sort of a market watcher. So,
okay.
But while I'm watching, sorry, go ahead.
And golf.
Yes. I have a 16-year-old boy, so it keeps me busy.
So you were going to share a little bit of this process, though, and especially your model for how you size up, the oil market and when to get involved, because, I'm checking it every single day throughout the day. You're looking for check boxes, basically.
Yeah. So as I'm watching, I mean, I stay involved. So I score the market. So once a week, I score the market. I've had a model for about 15 years. I call it MEPI, MacMinn Energy Price Index. So 17 indicators. I score them, simple model, 1 to 10. It's got to do, just a section on fundamentals, or there's a section on technicals and volatility. money flows,
Okay.
seasonality, weather, and geopolitics and macroeconomics. And I scored up 50 or below is bearish, 50 or above is bullish. And so the scoring doesn't generate a trade signal for me. The scoring tells me, and you've got a expression that's just worded a little differently, but it answers really the question anyone wants to know is it safe, right?
Yeah.
Like, is it safe? So then as you're watching and you see an opportunity, and that can be triggered by any number of things, you have something you can rely on and just quickly sift through that and go, in the context of the trade that I want to put on, is this safe? You know, nothing's a for sure, but is it safe? And so that's turned to be a pretty good model for me. So
But when
I
you
like,
get
as I mentioned,
when you
go
get a
ahead.
higher probability, 60, 70%, I mean, it's a little bit like counting cards, right? If you're going to get a 4 out of 5, you're going to go a little heavier than just,
Yeah.
okay. So when
So
you,
if you think about the model, if you think about when the model's 80%, that's an extremely bullish model. So think about it, then I'm actually thinking of going the other direction, right? So the more extremes the model is, I'm really fading my own model. So it's in and of itself as a sentiment indicator, you know, in terms of if I'm scoring very high on my model, then I'm probably, you know, the next trade's probably short of something, right? So it acts as a counter to probably the way I'm going to be thinking or whatever. So.
all right, so that's
And
the
you know,
trust.
from there, I just look for opportunities. You mentioned if I'm only trading, if I'm not trading very much, then I need to also trade in size, which also means that, you know, I have to have a pretty short leash on it if I am trading in size, and so it has to be fairly high probability, and that's why I'm not trading, and that's why I'm not trading very much. So
And also, there's
you know,
not a lot of interest in oil right now. We've talked about that. Open interest,
yes,
investment interest, you know,
yes.
so we're going to go into that. You actually have a
Yeah, well,
presentation.
let's just,
Which
you
would be
know,
fabulous.
bored of talking to everybody here, but why don't we just have a look at the market here first? And before I share that, Sam, I'm just going to get this page up on my system here. There we go.
You have started sharing your screen.
Can you see that?
It says you started, but it hasn't actually loaded yet, at least not that I can see.
Okay.
Oh, there it is. You're good to go.
There we go. Cool. So sort of a technical concept confirmation here. One view I like of the market, just line up crude oil, ULSD, and gasoline across. You know, there's a saying in oil trading, follow the products. Usually follow the products are leading. You know, pick up a lot of clues looking how different products are reacting at different times. So, you know, the general theme in the oil market here is we're stuck. You know, we're stuck in a range. Just have a look at crude oil here. You know, we're in a larger range between, you know, 33 and 43. We're in this 37.5 to 41.5 range. We've really been in it. I've dropped these trend lines off here since May or June. So we're just stuck in a range here. I really love ranges. Over like 20 years, I've found ranges are really important to me in trading the oil market. It represents we're moving into a new price regime. They usually last for a while. So I you know, on a very simple basis, technically, I like to look at the market in terms of ranges, and you know, we're in that we're in this range. That's a very well defined range.
And when they break, and I have to call out, go back to that bigger chart with the big gap down further to the left around May. You called that oil drop with precision. I was bearish, but to like $17, maybe 10, and you're like, nope, it's going lower. And I'm like, how can it go lower? And it went so much lower. But so I would love to know how that range, when you just went on to that prior, like when that broke, your conviction that we were going to have an Armageddon oil trade was so high, and you were so right. Was there anything technically that lined up to give you that call? Because
I think mostly flows there, flows, and obviously, understanding what the magnitude of in terms of the pandemic, what it was going to cause. There's a saying, the middle of the move is the easiest move. So if you remember, I was going to talk about, you remember right here, this is the $65 blip on January 8th. And that's what we talked that night when the missiles were in the air. So,
oh, that's right.
This was another regime here where we would call it, $50 to $65 forever. I could draw this back. So I was short right that night and, captured maybe halfway down this. And, honest with you, I just sat all this out, because I can understand it might go down, but, as when vol gets high, basically
it breaks the market.
Oil over 35 vol to me is, largely uninvestable. I mean, if you want a position trade, some kind of, how can you stand in there? So, I really caught the front end of this, and then you and I talked, we caught this little pop from, 19 was this huge number on the way down. And when we came back up, I caught this pop from 19 to 27. I think had some calls that paid off very handsomely there. So, there's large swaths here that look really great in the charts, but you don't necessarily have to trade them. So, we're just stuck here now. So eventually this will be a great range trade here to trade. I'm not active in that, but, pick your pleasure in terms of, you want to join the break above 43, you want to wait for a pullback, measured move implication, 43, 53, $10,
but big picture,
$53.
you have your
So,
4D.
the
How do they
range
come
is
into the range
ruling
break
here.
place?
And if you think what happened in the last week, we had the vaccine pill, we had a very bullish API.
You still there? Robert, my side or yours, I'm not sure. He'll be back, I hope. Can't talk oil like Robert. Halifax, internet. All right, well, short delay here. There you are.
There we go.
All right, I had asked a question, but you disappeared.
Okay.
How do the 4Ds that you have pinned on your timeline for Twitter come into this range bound play?
Not necessarily that, down to that level or whatever, but, now that we've talked, so I just wanted to illustrate to people that we're stuck right there now, like we're stuck. And I think I just wanted to take the participants through kind of why we're stuck on a bunch of different levels and show them kind of why we're stuck and how we're watching that. So I'll just flip over into PowerPoint here.
There you are.
Yeah. So I mentioned before about, not getting involved in forecasts. I think I tweeted out about that last week. I found over the years, and I used to have to write forecasts all the time. I get, research from everybody. And, I find that what you want to own is you want to own your trades. You don't want to own your forecasts. Owning forecasts are really tough. That becomes you, becomes your ego, it becomes your professional scorecard. And most of the time I don't know what's really happening. I just want to own my trades. Trades are like, easier to understand. That's your money. You get stopped out, you book a profit. So you try not to own your forecast. But one thing I did when I wrote forecasts is I always picked an annual theme of things I thought were going to be important. And I've sort of kept that. It's not so much a forecast. I guess it is in a way, but it's a framework for me to look at everything that's happening with oil. And I'll share a couple of things that we're going to talk about, stranded assets and deglobalization. But so 2 years ago, I wrote this for 19, which was, the 4Ds. I called it, deglobalization, decarbonization, debt separation, Donald Trump. So, I was on to early, we're just going to live, Sam, in a smaller world. Like, we're going to eat, we're going to kill, eat, we're going to hunt in our own backyard. Supply chains are getting disrupted. And it's not just a Donald Trump thing. Globalism isn't coming back any sooner. I've seen it happen in the individual sectors in the oil market. Markets get bifurcated, they get smaller. liquidity dries up. And I think that's just going to be an ongoing theme. I think you have to understand that's happening in the background. Decarbonization is really the energy transition, and I've got a lot to say about that. I think, it's the most profound thing that's going to happen in the energy business in the next 10, 15 years. I think it has some great trading opportunities there too. Debt saturation affects everybody. I mean, sovereigns, people, corporations were leveraged up. That impacts what people can do, what happens to them. And Donald Trump was a search for a D. But really what it is.
Now it's Democrats.
Yes, exactly. But it's really the market says political utilities,
Okay.
Simple thing about Donald Trump, I always viewed Trump as, as a range guy, like below $40, come to the rescue, above 65, not good. If you remember January 8th, like, there was lots of other signals that were telling me that was an easy short. We'll see in a second. Specs were long. We're at the top end of a range. But, one of them was I just felt very confident that Trump wasn't going to slap back at them, So here we are at 65. The missiles are in the air. Some stuff's coming out. Well, maybe this is sort of prearranged and it's not going to be so bad. And, in my mind, 65 was the top for a whole bunch of reasons. And political utilities was one. And Donald Trump was one. So I don't try to fit things in here, but when you hear some of my thoughts about decarbonization or energy transfer, like these are all important themes that are going to continue. You see, I have my tweet here. Hey, it worked in 19, so it's going to work in 22. So we kind of yeah. So I just want to take you through quickly. I don't know what the interest level in this, but just to kind of show you how things are stuck. So this is gasoline demand, 4-week average by the DOE. We have our V-shaped recovery and then boom, we're kind of flat. And you can see we're just, trending along with prior years, so the black line is a 5-year average and the blue line is 2019. So, we're just sort of stuck here and we've been stuck since June or July. We're just kind of flatlined along here. So I'll just quickly take you through these. I like working with a lot of rate of change stuff. And by the way, I do all my own charts. I write my stuff down in a book. I build my own Excel spreadsheets and to do my charts. People think, well, that's a waste of time. It's part of my edge, like working with the granularity of the numbers, understanding, looking and seeing, oh, what was that yesterday and how'd that change is part of me understanding and really getting more of a pulse in the markets. So I like a lot of rate of change stuff. This is total demand growth, sort of, a little bit of improvement in late, but, again, this same pattern we kind of stalled out here. Distillate demand, has been increasing, but you can see here we just backed off recently, and, still 9% below last year, unable to sort of bridge the gap versus last year. Terrible report today on distillate growth. 4-week average is, down to off 400,000 barrels a day. Jet fuel's really been, it's just been locked lower. It shows some type of improvement here, but if you check the green line above, which is 2019, which is very strong year for jet, we've been locked, 40 to 45% below 2019, basically forever.
When's it coming back?
As soon as people start flying. I'm not quite sure when that's going to be. I think it's going to be a while. Everyone's made a forecast on that. I'll just watch it, but the market's really not getting better until that happens in a big way. So, a lot of problems with jet demand. This is just
big layoffs at the end of the year were announced for all the airlines today.
Yeah. This is just total demand, same thing. We're 2.3 million barrels below last year, 10% off. Same thing, just showing that we're kind of flatlined out here. Crude stocks had a build this week, which was kind of bearish. You can see seasonally we're going to start coming off now. We're even just to stay where we were or even grow here, which is not likely, but people are all excited about the amount of stocks have declined. I mean, look at the chart. A lot of it's seasonal. We're still 40 million barrels of crude oil over last year. Is that spread narrowing over time? Some, for sure. We are getting better, but there's a tremendous amount of supply discipline in the market. OPEC has 8 million barrels of crude off, and we're running, 2.6 million barrels less crude into refineries. So both refiners and producers have a tremendous amount of discipline here. And I think people miss the discipline part. Is there potential for a supply demand deficit going forward? Absolutely. But as a trader, timing is really important. This is gasoline. Gasoline, is the best stock configuration of the three products. We're back into a zone that's more normal or whatever. We're still, 3% above last year, but that's definitely looking better. And distillate's been the big problem, 30 to 40 million barrels above last year, falling like a stone of late, but that's a seasonal fall as well. So, we'll see what's happening there. Obviously, jet originally got, initially after the pandemic, got dumped Caro into the distillate pool. Jet fuel stocks actually are right in line with last year. So, the distillate problem is really a jet problem. And so, there's uncertainty about that going forward. And then on a total basis, just as combining all crude oil, gasoline, and distillate, we're still, almost 80 million barrels above 2019 or 10%. So yes, stocks have come off, but look, it is seasonal and there's still a large gap. So there's a lot of work to be done. And that's why we're stuck. That's why we're kind of taking you through this. Just a quick look at refining margins. So, different refiners running different crude slates, selling different products at different prices, but it's just a proxy for refining margins taking NYMEX crude or RBOB gasoline over WTI crude. So, spot gasoline crack, just under $8 a barrel, $7.70 for the rest of the year, $9.91 for all of 20. Single digit crack in the forward curve for all of 2021. So 40% below the 5-year average. So if you want to know why oil company earnings are under pressure and why they're holding back on runs is refining margins are, quite frankly, are terrible. A little bit of a pop in the distillate crack of late, but it has been choppy. Same thing though, like distillate cracks were the strong feature of the market the last few years. I mean, look at the 2019, we averaged 24 and almost a half a barrel, but we're still 40% below 5-year average for the average for 2021. So a lot of work to do there. Another good signal about why we're stuck here.
You got to get to the point where at some point, what someone's going to ask, so will Biden unstick it?
I'm not quite sure about that. Yeah. Just a note on refiners, refiners have really balanced. Let's go back to cracks here. I thought I had runs on these charts, but maybe I don't.
I love that one you just.
Yeah, we'll come back to that. Just get into the money flows. But, refiners just hunkered down right from the start. A lot of people didn't think that. They thought as we start coming up to the V-shape, refiners would release. I mean, they just basically balanced the market on their back, the prox market. And they're not going to increase their runs until the market gets healthy. And that's just very clear. Think about that too. Without any government support, this isn't like, people propping up the market. They just basically hunkered down. They hunkered down, turned their kettles down. And the market's, largely balanced, so to speak. The stock surpluses aren't growing. And, they have it under control, but they're not running very much crude. I guess I lost that chart in the transition somehow, but, we're running 2.6 million barrels a day less than last year. So, we're turned down and, another function here of kind of why we're stuck or whatever. So just want to do some stuff on money flows. So I like looking at the speculative interest. I like combining actually in the complex. I like combining crude, RBOB and ULSD contracts. So
this is my favorite chart.
Well, you look at this chart and, it's pretty interesting. The market's not very long. Like, in fact, we've been coming off here. The problem is, and I hear a lot of people go, well, geez, that's great. That's dry powder. Well, dry powder is not the accelerant, right? This is a condition. This isn't an accelerant. So yes, speculative interest from the long side is low. However, it acts as less friction when you start going up, and what creates it going up is you have to have new buyers, and there's been a lot of apathy in oil, and that's a bit of a segue to the next chart, which is just the green line's crude oil price and the red line's open interest. So look at open interest, gone from 2.7 million contracts below 2 for a while, and we've just been sort of flatlined out here, chipping and chopping our way. So tremendous amount of apathy in oil in the last couple of years now. Why is that? Like, I did a little bit of work on this, looking at some of the trade categories. There's not really a dominant theme in terms of why someone pulled back, but, obviously lower prices, less fuel being sold, less hedging being done. But there's also an element here, the speculative components have declined as well in terms of the percentage of traders. So it just hasn't been a really, you trade all the markets, Samantha. It just really hasn't been a very friendly place. There's been other safer places to hide and trade. Equity market's been ripping, gold's been ripping. And so, oil's a
Bitcoin.
beast and it's very hard to trade. Yes. So, I've always, I'm really focused on this open interest now. Every year or two, you get a real theme that you want to watch. And I'm really fascinated by this apathy in oil trading. And people are talking about oils going back to $60, $65. Sure, it can happen, but we need some new players to come in, right? They say, the open interest is the oxygen, it's the oxygen for the fire. So, if you want to track one really metric that's important to me is kind of open interest or whatever. So
Excellent.
this last one is just that flat number of speculative length, but it's comparing it to the open interest. Sometimes a lot of people get confused by just looking at the flat or nominal speculative length numbers. I like comparing it to open interest because, obviously if we've lost 700,000 contracts, then the amount of open interest can still be high, even though it looks low on a nominal basis. So I just sort of arbitrarily have drawn these 15 and 25% lines in. And you can look when the speculative length gets above 25%, those are some like really tasty sales. And if you look where we're at right now, we're not even in the middle of that range. So it sort of tells you too that, maybe we're not quite out of the woods yet, and this thing's not a rocket ship. And it's just another signal that what we need to fix that particular ratio is we just need some new oil traders to come in. So we're watching for new players to show up because they really haven't. So, and again, so if you think about all this money flow data, same conclusion, we're ending up with it being stuck, right? So that's just, I want to give everybody a feel for kind of what we're doing and
Thank you.
And why we're stuck, and some of the things to watch for to get unstuck. And then you can trade how you want to as you see those things happening. So this is, I tend to talk a lot in code to a lot of people on Twitter. I think some really smart people might figure me out just because of my sarcasm, but I've been watching for a long time, and I love to see, when you watch, you see narratives and sentiment build up. And there was a little tweak that tweaked me off here, which was OVX, which is the oil volatility. But
yes,
I'm just sort of calling people out here. Like, what are the real strong narratives right now? Well, geez, we've been moving forever into this supply demand deficit. When's it coming? But it's going to be there. And then geopolitical risk is low. And it really is low. And everyone goes, well, yeah, there's a really good reason for it to be low. Yes, there is. Like, there's a ton of spare capacity in the market. But what about some really bad stuff? Is that really priced in? And when vol is cheap, I want to own that tail risk. And I did. So, what I ended up doing was I bought some very long dated puts and calls.
I know this fascinated me. When you told me this trading tactic that you were using, I was like, you're buying puts and calls at different, the underlying and the integrateds. Explain this to me. And you were right. This explosion higher and lower, they both happened within the frame of 2 weeks.
Yeah. Well, I just figured within the, this was it was a vol signal more than anything. But, for example, just some of the backdrop is, I didn't know who was going to, obviously, this was on October, put this on, 3 days before that, I think. But I didn't know who was going to win the US election. Trump's been actually, absolutely taking apart Iran, leaning on them.
Mm-hmm.
If he were to get back in, stuff can happen, even administrative change in the US, and everyone thinks, oh, it's going to be all wonderful and hugs and kisses and kumbaya. And it's been really quiet and on the geo front. And I want to own some risk. No one's been talking about it. It's really low. No one's there's a passivity on geopolitical risk that I just want to own, just kind of put away. So it's just simple, buy long dated calls, buy long dated puts. And I actually thought, and actually I've taken one leg off, is that both, I could get paid on both. So,
yep.
And then this concept of, US crude oil production has peaked. Has it really? We'll see what kind of happens out there. We have this OPEC meeting coming up. They're going to do what it takes to support the market. What happens if they don't, for whatever reason? And we've seen some pretty wild outcomes there. And there'll never be a demand setback now. We're just talking about a recovery. And if you think about that, even as the cases in the US have been escalating here, the COVID cases, there's quite a bit of apathy that was leading through that, that we're going to be okay here. It's not going to be so bad. I think the market was just kind of ripe for a tiny little bit of a setback here. So basically, I put that one trade on, and I just want to show you and I had talked about this, because I remember when I sent you this chart, I said, fall's coiling here, like something's going to happen, and you were like, it's coiling everywhere.
It is.
Yeah,
it was. It was the euro. I was like volatility, NASDAQ volatility, bond volatility, euro currency volatility. Oh yeah, and oil volatility.
Yeah.
So I sent you my charts going, I know you just trade oil, but it's all coiling.
Yes, I know. So I didn't have the longer term framework here, but I spent a lot of time working with OVX, and I'd never seen a triangle like this off of a bottom like that. I look back and I just couldn't draw it on the chart, and I'm thinking, well, that's kind of pretty special. So we haven't had this pop higher off this, and then we pulled right back. You and I were talking just before we came on about maybe that could come right back down to the bottom line, or even better, a false breakout through the bottom and then explode or something. So so I think that's
not how the market is really positioned, though. They're right now, as you know, and I know the dollar isn't just so high and mighty in your model, but the dollar shorts, they're just starting to, to release, if you will, the lever. But this is the 30-year treasury, the dollar, the VIX short. There has been a very crowded trade, especially on VIX to the downside, and they were right through the election. But it is, it is curious that your OVX is also finished breaking out. It's come back to retest. I can tend to go back inside that wedge, kind of like overshoot to the downside, have the energy, and then move higher again. But we need a trigger, right? We need some kind of narrative to fit. What's your thought on, President-elect Biden coming in? What's the feel as far as the oil trading market under a Democrat leader? I just want to finish off a thought on that trade first. So you think about, we put this trade on right about here or whatever, and so we're looking at our charts, we're looking at all the rest of our EPI when that happens. So we had this explosive move down through here, which turned out to be a false breakout, but a really, a big probe here. And then you could see it just wasn't going to follow through. And, to come back to some of the other inner workings of the model is we had no rise in open interest, and so that was really troubling. It was sort of smelled out that, that's a nice break, but it's basically, I'm thinking that's not following through the way I would like it to. So we took that leg off. It ended up being like a 3-banger. I'd like to get it back on because I still think anything can happen here, but I'll need vol to come back down, right, for that to happen. So that was sort of the end. That sort of taking that trade from sort of thinking about something to get it executing, and then trying to get it back on. So a bunch of stuff there. I mean, on Biden, it depends on who's going to control the purse strings. So who gets control of the Senate? There's lots of forecasts. Potentially, the non-drilling on federal lands could be as much as, I've seen anywhere from 1 to 2 million barrels a day by 2025 or something. And then, of course, if he doesn't control the Senate, I mean, the stimulus package is going to be watered down or something. It seems to me like there's more risk to the downside than higher. I think oil prices, which is kind of a bit of a segue here back into, stranded assets, is it's clear that all of the stranding of these assets is going to lead to a period. There's been many studies done on this, not that I believe in forecasts, but it makes a lot of sense to me. There will be some period of time here of much higher oil prices because we're just stranding assets. Like if you watch Twitter every day, it seems like there's a refinery closing, somebody's going bankrupt, somebody's combining assets, somebody's changing focus to a different part of
the ESG rainbow. So there will be higher prices, and those higher prices for carbon actually help the push to renewables. It helps the Green New Deal, if you want to call it. So that's the theorem on. I'm just going to share the screen here.
So
that's the theorem on stranded assets. Yeah, it's just as part of that decarbonization, a bunch of people are just getting out of the business. And you see it happening every day. Regular fuel companies trying to become renewable companies, trying to become power companies, quitting, going out of business. And so I want to own the companies that are going to stay in. As my saying is, I want to own the companies that are going to turn the lights out. So I also have a theory about what that company looks like. And to me, it's going to be in major integrated companies. It's going to be somebody that does everything. It's sort of a back to the future when I started, where someone has upstream, they have midstream assets, they have downstream, they have refineries, they have onshore, they have shale crude, they have global crude, they have nat gas. So, and there's only a few of those. And they're really just, Exxon and Chevron, really, in my mind. So as a longer term trading strategy, I want to own at times a lot of those companies. And so I think they're going to go higher, maybe much higher, not in a straight line. But then I can trade around them. Once I establish that as a core position, I can trade around it. I can do pair trades against that. I can sell losers. I can sell losers that think they're winners. I can use them to make flat price bets, because they're pretty good proxies for oil sometimes. They can be refining margin bets. Of course, Exxon, as you know, pays, depending on what your entry level is, 10.5% dividends. So you have some protection there. People talk about the dividend go away. That's definitely a risk. So I want to establish a position in those companies and trade, because they're going to be it's pretty clear that they'll be the guys that are going to turn the lights out. And so I want to own those companies, and I want to trade around that position or whatever. So just got a quick.
But that's a time frame that's not next.
That's a long time frame. But,
yeah, you're several years out. But that's not how you trade. I know how you trade. It's much tighter. When you see the range break, you go in. You might use the integrateds as the underlying. You also use oil itself. How are you often trading a crude?
That's a very perceptive. So I always start wanting at times to be a position trader, but it's just not in me. But I'll hang with it for a while. So I've had the stranded assets theory for a long time. I've been I certainly want to own Exxon, anything close to $30. I owned it here. I think I sold it here. I just stayed out here. I came back in. I bought some in here. I got a little bit of this pop, and then I just loaded up, as you know, here in early November. Caught that great big explosion, but I do want to hold that, right? I do want to hold that. And from some of these little pops here, I have some very long dated calls in Exxon that I'm prepared to take, and that's a bit of an option on the stranded asset theorem as well. So I'm going to give this current position, which is pretty large, some room here. We've had this gap higher. We broke this downtrend line. I want to get your feeling on gaps. I put that question out to gaps are a trader's nemesis, aren't they? How do you deal with them?
Oh my God, I love them. Because the personality of a stock and gaps are very tightly integrated. Some products, or the underlying, they're very gappy products, so that makes it tougher. Those that don't have gaps as a characteristic, they're going to fill them. There are no gaps. They will fill those gaps.
Well, it's the old trader's axiom, gaps always get filled.
Yeah.
So anyway, I'll wait on this one.
Not in every vehicle.
Right.
I mean, you can really. So yes, I do believe that this is going to pull back to the trend line, and we'll have another reflation opportunity. But this is not it's not like, don't worry. Personally, it's what I told clients, because we definitely traded the first one from April, May until June, and then obviously it did it again, but in very short order. I think this back and fill is going to absolutely take place before continuing.
I mean, we have this island reversal up here, call it in this $56 range. I mean, I think that's a very realistic target. I mean, that's just me talking, but
in time.
Oh, over time, for sure.
Yeah.
So, I have a decent position in that now. I want to have that, and I can do all kinds of things with that now. I'm collecting a dividend. I just got one the other day. I mean, it'll be paid in December, 2.6%. So I have this position, and I want to hold it. I can sell calls off against it. I can do all kinds of stuff. I can short something against this on a relative basis. So that's sort of the stranded assets, my stranded assets theory. So
Are there any other players?
I can be active. I can be active in that role. Not really. I mean, I tend to, Exxon's a company I know. I worked for them for a few years, like 30 years ago. Understand their culture, understand their physical operations. I understand what they're doing. I'm not saying they're a better company than Chevron. It's just, what do people say? Trade companies, So I know that company.
So you're not going to jump on the bandwagon of the China EV auto manufacturers of LI and NIO and XPEV that are hot fire flames, right? That are trading at, $1 million a car, basically, in market cap. So you're not going to play that game.
Well, that's a great question. Someone asked me that the other day, I'm sorry, I'm an oil trader, right? I'm going to keep trading oil. I'm not going to run off and try to buy a solar company or, a renewable company. I have no expertise there. I have no edge. So for me, I'm trying to figure out who's going to stick around, and it's going to be a long time. I mean, we're talking decades, right? Fossil fuels are dirty. Yes, they're also cheap. And there's very little room left to how these companies can reinvent themselves too, but in a marginal way, right? I mean, there's a lot of companies. I mean, BP, beyond Petroleum. What was that, 20 years ago? I mean, it's not easy to make that transformation. So Exxon, I feel confident it will be there in some form. So I want, as an oil trader, I want to have a piece of that. And, the regular stuff that the trading comes up every day, and I can trade that kind of tactically, because I can kind of be in and out of it, but I know hopefully it'll be kind of a rock. There's not many options either. We didn't get a chance to talk about USO. It's such a shame that thing kind of blew up,
It did. It's not trustworthy now.
Well, I mean, they ran down the curve and reverse split. So
yeah,
it's not a very good proxy for oil.
Nope,
and XLE has its own baggage too, like I say.
It's heavily weighted with Exxon.
It is in Chevron, but only about 40%, and the rest is stuff. Yeah. So I'm, I say about XLE, it's never oil unless you want it to be, so I've never had much luck with that. So it can depart from flat price, and I never got comfortable trading that. Short term, you could trade USO in the old days because they were clinging to the front end of the curve. Now they're down the curve. And, I mean, I think at one time they had 150,000 contracts, plus they had 27 contracts on ice, I think. So I think they're down well below 100 now. So it's just, it's difficult to trade that. So, it's a decent enough proxy, and you can always trade futures and options on the NYMEX. So that's kind of where we're at, kid.
I know, and it's a good one. I mean, the range bound, the 4Ds, the process, the model, some of those wonderful oil trades, and Exxon, the reflation move right now, quote unquote, from this Monday gap up that was outsized, and once in a lifetime, it was a 10 sigma move between the energy complex and NASDAQ. So it put some tremors, into the shorts, and they did a nice short covering rally, which I have said can be the start of a trend reversal, but I still contend with the yield, play right now, up, down, and all around. It's more likely to back and fill before we get a really nice noticeable pattern. And my intermarket is still weak in that whole oil patch. So yes, we talked about Exxon. It's at 32.70 over the few weeks, and it held. It overshot. That was an example where it overshot, came back up. Volatility was still coiling. It's still, these are still viable plays, but you're right. It is grinding, if you will, in a box. You are doing a great time of timing it. Great job of timing it. I was curious to get your views, especially with the, let's say, a new regime change with looking like, Democrats coming in. Would there be any substantial change in interest as an investment in oil, or it's still wait to be determined?
Yeah, probably not. I mean, I think the net impact of whatever happens will be higher prices along that transition, because you're going to need those to make the transition. So, I mean, that's pretty easy. I always like the macro stuff. You and I have joked about this. I mean, down, down US dollar, higher oil, but they've been talking about that for 6-8 months. This is the way you need to do the work, is what I say.
Yeah.
Do hashtag do the work. It's like, if the reflation trade's on, you see that open interest chart we have, we'll have the new buyers. They'll be there showing up. You know what I mean? The specs will be coming into the market.
It hasn't had an impact on Bitcoin. It hasn't had an impact on gold. And I track this stuff closely. So it hasn't made your radar either. When it does, then I'll start to worry.
Yeah, I'm sorry. It's just lazy. Like, you can't build your trading platform around forecasts and correlations. I believe, you have to do the work. You do the work. I do the work.
And I'm so glad we can share
it. And
it
it'll confirm, I'll go, hey, look, the reflation trade's on, if that's what you want to call it. I'll call it, there's more buyers coming. There's new buyers coming in, and they're shoving the market up. And I'll see them along. I'm not going to miss it. We're not going to wake up tomorrow and it's going to be done. There's no opportunity there. So it's great to put these names on it and have all these correlations, that work 9 times out of 10, 5 times, 50% of the time. But at the end of the day, when we do the work, we'll see it.
Oh, thank you so much, Robert, for doing this guest captain interview series. And where can folks find you?
Yeah, at Robert MacMinn.
You are a private.
No, I lay under the radar. Yeah, but
no. But you're a private trader, but you're also a consultant. So you do supply your analysis and trade setups to hedge funds and others. So where do they find you?
Yeah, just through Twitter's good. You can ask me to DM you, and we can make a contact, and we're good to go.
Okay, low marketing expenses. Thank you so much for the time. I really appreciate it, and I wish you a great night.
Great.
All right, good night.
Talk to you later. All right, take care.
Bye.
All right, see you.